At midnight on July 24th, Bitcoin opened just below $66,000 before starting a sharp, continuous descent. By 4 a.m., the price makes direct contact with the dense yellow bands concentrated at the $65,000 level. At this point, the descent accelerates into a nearly vertical drop, plunging through the $64,000 floor. As the price stabilizes near $64,000, the heat map shows that the previously bright yellow liquidation clusters have been completely cleared, leaving behind a dark void. Retail perception often labels these sudden drops as random market panic, though the quantitative data confirms a precise algorithmic structure. This mechanical event is known as a liquidation cascade. The rapid decline resulted from a calculated sweep of a defined liquidity zone. In highly leveraged environments, price action is drawn toward pools of dense liquidity. Institutional volume and market makers utilize these dense pools of retail orders to fill their own large positions without causing significant price slippage. To understand how the July 24th cascade was engineered, we have to perform a forensic deconstruction of the data, starting on July 20th. We are tracking the systematic buildup of leveraged positions over a 4-day period, the fuel that made the July 24th crash mathematically probable. This hidden accumulation is made visible through a specific analytical tool, the liquidation heat map. Analyzing the cascade requires reading the invisible topography of market risk before the volatility begins. This is the baseline market state on July 20th. The y-axis tracks price, while the left gradient maps color to estimated liquidation volume. Horizontal bands show concentrations at precise prices. Bright yellow and green indicate high concentration. Dark purple represents empty zones. Each data point on this map calculates a trader's entry price, combined with high leverage multipliers, such as 25x or 50x, to find their exact bankruptcy threshold. The system aggregates open interest across multiple exchanges to create these estimated liquidation levels. A common retail misconception treats a bright yellow band as a traditional support or resistance level that will bounce the price. Functionally, these bands represent targets, trapped liquidity that larger players can exploit. The heat map visualizes off-book kinetic energy, pinpointing exactly where maximum financial pain is clustered. From July 21st to July 22nd, the price remained in a stable range between $65,000 and $68,000. Periods of sideways price action often encourage traders to open new leveraged positions, assuming the current stability will persist. The data shows this accumulation clearly. Thick yellow bands form simultaneously at $67,000 above the price and $65,000 below it. On July 21st, the price pushes upward and pierces the upper yellow band at $67,000. Mechanically, the market makers consumed that topside liquidity to fill their own orders. Once those orders were filled, the yellow band turned purple and the price rejected sharply back into the range. This specific micro-behavior is known as liquidity hunting. Market makers sweep these isolated pools to fill their bulk orders before allowing the price to settle back into the established range. Sideways ranges act as accumulation zones, where market makers systematically sweep isolated pools of leverage. On July 23rd, the overall market price began a slow, drifting descent. During this drift, a dense yellow band formed between $64,500 and $65,000, growing in brightness as the price approached. This identifies a shift in retail psychology, as traders attempt to catch the dip by opening high-leverage long positions. This strategy creates a structural risk. Thousands of independent traders are placing their liquidation points in the same narrow price band. This uniform placement aggregates individual risk into a highly concentrated liquidity pool. The deeper this pool grows, the stronger its gravitational pull becomes on the market price. This glowing band represents enough stored kinetic energy to completely destabilize the local order book. At 4 a.m. on July 24th, the price intersects the top of the accumulated $65,000 band. Moving from the macro heat map to the micro order book reveals the millisecond level. The trigger begins when a highly leveraged long position hits its bankruptcy price. The exchange's risk engine automatically executes a market sell order. This forced sell order adds downward pressure, pushing the market price slightly lower. This creates a cascade loop, as the downward push instantly triggers the liquidation of the next tier of positions. This micromechanical loop is responsible for the extreme velocity seen on the macro chart as the price plunges through $64,000. The result is visible on the heat map as a dark void where the liquidity was fully absorbed. A long squeeze is a self-fulfilling algorithmic cycle where the destruction of one leveraged position provides the market pressure required to destroy the next. Following the crash, the price stabilizes near $64,000, having cleared the bands previously sitting in the $65,000 range. The downside liquidity has been swept, removing the immediate gravitational pull below the price. As the new day begins, market participants react to the recent downward momentum. Short sellers are now entering the market, building up new leverage pools near $65,000. The magnet has flipped. With downside fuel exhausted and new short positions accumulating above, the path of maximum liquidity is now to the upside. Market gravity is cyclical. The destruction of long liquidity clears the board for the accumulation of short liquidity. Liquidity heat maps cannot predict the exact timing or the specific catalyst of a market move. They reveal the underlying topography of market risk before a move occurs. Tracking where these leverage pools are deepest allows an analyst to map the market's path of least resistance. Quantitative strategies prioritize these underlying liquidity shifts over traditional chart patterns. Mapping these concentrated leverage clusters provides the data needed to identify where a liquidation event is most likely to begin.